Hello traders and welcome to Financia.com. Today, we will discuss everything you need to know about doji patterns in MetaTrader, also known as doji candlesticks in TradingView platforms. Let's begin by defining these candlestick structures. The doji candlestick forms when the currency pair opens and closes at almost the same price inside the timeframe of the Forex chart on which the doji candlestick occurs. To explain, this implies that the exchange has not yet decided in which path the price would continue. Despite the price has oscillated between open and close prices, it closed at the same open price. A doji candlestick can form in two ways. Either, bulls attempt to drive the stock market up while sellers reject this by trying to push it lower again. Or, bears try to push the currency down while buyers refuse the situation by attempting to drive it higher again. To clarify, upside and downside moves between the higher and lower prices create the wicks of doji candles. However, the body is almost negligible as the Forex market opens and closes at nearly the same level. The doji candlestick tells us that neither buyers nor sellers are gaining control over the FX market. In other words, the doji candle indicates a state of indecision or neutrality between Forex traders. On the one hand, a doji pattern can reveal an upcoming price reversal. However, this is not always the case, because it may alert that bulls or bears are accumulating for the trend continuation. Let us discover how to trade reversals using the doji pattern on the Euro/USD 4 hours Forex chart. A doji candle often indicates bullish or bearish reverse signals after big moves. In fact, it shows that the prior move is losing its strength. Here, we can spot that the price reversed at the bottom of the trend with a doji formation. To explain, this was a bullish doji as the currency pair reversed with its appearance. The same chart illustrates how the currency pair switched its general direction after the appearance of the doji candle. First, the price was trending up, which means that bulls were dominating. However, the doji candlestick formation suggests that they were unable to maintain this state of dominance to keep prices higher. Here sellers were pushing the currency back to the open price. Then, the move reversed, and the price began trending down following the bearish doji candlestick occurrence. In short, the doji candlestick is bullish at the end of a significant downtrend. Alternatively, bearish at the end of an uptrend. So, it serves as an entry signal after big moves. Thanks for watching this doji pattern video tutorial.